Hello folks, this is Raj Sastry from Raj Option Trading. Today I want to talk about buying stocks, buying call option or call spread, selling put options or put spreads. So with that, today is April 26th, 2021, and we'll go into some of the details. And many times, these are, good opportunity to buy stock also. So you can use this, these strategies for next week, week of 26th, and take it from there. So with that, here is a list of stocks you can use to buy stock, or you can use it to buy call options or call spreads. So with that, these are based on TTM trade from John Carter. The way this chart is organized is, we got stocks here all the way from Disney to Dow here. These are organized by TTM squeeze. So either 1 day squeeze. In case of Colgate, there's a 1 day squeeze, and Dollar Tree 1 day squeeze, and then I listed 3 day squeeze also. In many cases, CFG, AMRS, and so on and so forth, there's a 3 day squeeze. And then there's a 1 week squeeze. As you can see here, Walt Disney, there's a 1 week squeeze or a weekly squeeze. And I also have 1 month squeeze. In this chart, there is nothing for 1 month squeeze. The way I like to play is, really I like to look at fundamentally good stocks. For example, as you can see here, there is a good sales growth. I mean, in Disney case, sales growth is negative. It's granted because Disney has been closing its parks for a while, or maybe with less capacity, but it's a reopening play, so there is a bullishness with the stock here. And I also listed these stocks with the IV percentile low. So as an option buyer, you want the implied volatility to be low, because otherwise you'll be paying more for your options. So that's why these stocks have got low IV, below 50 for most part. And I also want, because we are buying stock or buying call or call spread, we want RSI to be a little bit lower. So these RSIs are really less than 60 or so. So that's why, I want to make sure, there is upside for the stock. That's why we don't want IV to be too high. And I also want to make sure, sometimes I pay close attention to put call ratio. When the put call ratio is low, like here, that means more calls are being bought or traded than put. So that's a bullish indicator for most part. As an example, if you look at Dollar Tree here, Dollar Tree, more puts are being bought. That means people are a little bit afraid that Dollar Tree might come down. That's why people bought more put. And same story with Maxar here. Sometimes you can take this as a pinch of salt and use this as a contrarian indicator to open a position too. Then I typically like to look at sales and sales growth. And one more very important thing is gross margin. You got to make sure it's a good gross margin. And earnings are around the corner, so you got to be a little bit careful. So if the stock has run up into the earning, then you want to pay close attention. Probably not a good idea to buy. But if the stock is low from a 52-week high, and stock is kind of not too hot at this time, then it's a good time to buy some call options or even stock. So pay close attention to how far away it is from 52-week high as your opening position to buy stock or call option or call spread. So with that, these are my favorites here. As you can see, we'll jump into some of these things. We'll go into Thinkorswim platform and try to open a couple of positions here just to see how it pans out. I have got more here, the same story. In this chart, you also see some monthly squeezes. For example, ALNY, we got a monthly squeeze here. Collegium Pharmaceuticals, monthly squeeze. So monthly squeeze are supposed to be a little bit longer term, meaning this will last longer. So I think when the fundamentals are good, when there's a monthly squeeze, it's good to trade along the side of the squeeze itself. And also look at 52-week difference. So make sure there is more room to run for the stock. And same story, IV percentile is relatively low here because we are the option buyers. We want IV to be low. PC ratio, pay close attention here. Sometimes when a PC ratio, put call ratio is high, that means people are a little bit hedging and buying more put options. For example, ALNY, people are a little bit afraid, they're hedging their positions, buying some put options here. And I also made sure RSI is relatively low, below 55 or so. Then you got one more list here. This list is basically low percentile and low RSI. Let me quickly take a look at this here. Percentile, IV percentile. Yeah, it's a low IV percentile. So because IV percentile is low here, you could, this is not based on TTM squeeze here. It's generally based on the volatility. IV percentile is low and RSI is also relatively low. So when IV percentile is low, RSI is low, whether there is a squeeze or not, you can really buy stock itself or buy a call or call option. So I also highlighted some stocks which are fundamentally good. For example, Arcadia, IRTC, Anglogold, good fundamentals as you can see here. I think this is where IV percentile is also low. And earnings around the corner. You got to pay close attention to the earnings date, so that way, you don't get blindsided by this. Then we got a couple more here: Emergent Bio, Kirkland Gold, Exelixis. Same story here. Nice sales growth, low IV percentile, low RSI. Because of this setup, you can be sure that you can buy options without paying too much money, because IV percentile itself is low. And I got a couple more here. NortonLifeL, Checkpoint Software, other steady edit company, down 14% from 52-week high. GoDaddy, another good company, down 9% from 52-week high. And last but not least, Elanco Animal, they are down 11%. It's really animal pet theme here. Stock has room to grow. So with that, we'll go into next one here. This is probably the last slide. This slide talks about high IV percentile stocks, and because these are high IV percentile, you can really sell put option or put spread. Because it's high IV percentile, you will get more premium by selling put option or put spread. But you can also buy stock here. You don't need to really sell only put options. You could buy stock because these are really low RSI. Many cases low RSI, and they're pretty much down from 52-week high. You could buy stock also. You want to make sure with this setup, selling put options or put spread, you want the stock to go up. So whether it's selling put spread or buying stock itself, you want the stock to go up. Because IV is high, here we are selling the put option versus buying call option in the previous scenario. Because IV is high, when RSI is low, this is when you sell put options or put spread. But in some cases here, Alchemist as example, RSI is relatively high. When the RSI is high, in those scenarios, and the IV is relatively high, you could also think about selling call options at a higher price. So that's because IV is high. You are thinking RSI is high. You are thinking stock may come down. But normally when the RSI is low and the IV is high, your strategy is to sell put option or put spread. So with that, let's go back to the first slide, and we'll look at some strategies here. First one, I'll look at Disney here, DIS. Let's go back here, Disney. So if you look at Disney here, let's go to the chart quickly. So if you look at the chart of Disney here, nice looking chart. I see if you make it a little bigger here, um, the volume is on the balance volume is relatively steady to going up a little bit. That's a good sign. RSI itself is flat. Try to probably make a leg higher here. DMI chart is indicating right now bears are in control, and volatility is low. That's why we are really buying the option here, or buying the stock. And check in money flow here, it's showing a positive strength here. So smart money is flowing into the stock. That's a good sign. So that's a bullish indication. So with that, we also, let's quickly look at uh, Ttm Squeeze Chart here. As we can see here on the daily chart, we got a nice squeeze forming here. That's a good sign. And I think there is a small red line here, and on the longer term A wave, it's above zero. Shorter term, longer term C wave is above zero. Shorter term A wave, I think it's below zero at this point, but we can discard the shorter term, go with the longer term here. And I think in the 2-day, there is nothing significant here, and there is also a squeeze in the weekly chart here, and the longer term C wave is above zero. When the C wave is above zero, it's a bullish indication. So you can sometimes ignore the A wave for most part, because C wave is above zero. So with that, I feel confident. This could be a good play. This might fire in the longer term, given that A wave, C wave is above zero in the daily chart. C wave is above zero in the 2-day chart, as well as in the in the weekly chart, and also in the monthly chart. So with that, let's go to option chain here. Look at Disney. So typically, with Disney, because we are buying the call option, I want to go out, maybe say 173 days out in this case, and I would. You could even do 82 days, not a big deal. I want to make sure, if you do 82 days, exit out, maybe, when you have a good profit. So with that 183 the stock price, I would go maybe 180 here. I could even do 175. I could do 175, 185. So if I do that by vertical, 175, 185. So I'm paying $5.53 here, and I'm making 447. It's to make the risk reward a little better, I would maybe do 175 and 190. So that way it's a $15 wide spread. I'm paying 758 for this spread, and I'm making 742. So here it's by your almost doubling your money here. That could be good proposition. So you're risking $758 and you're making $742. So this is one way to play with the $15 spread. If you don't want to spend 758, you could also reduce the spread. As an example, stock price is 183. You could do, if you want to be a little aggressive, you could do 180 as an example, or 177. That's a better bet here. 177, and you could do 187. This is a $10 spread here. That's not trading here. Let's see. We could do 190. There you go. This is a little smaller spread. That's not trading here. I think we are back to 180, 180, 190. You could do this also. This is a a little aggressive spread because you're a little bit below your first spread here is a little bit below the current stock price. A little aggressive, but risk reward here is a little better. You're paying 453 and you're making more than you're doubling a little more than doubling your money. So your break even price is 184, a little bit above the stock price. So this is a little bit aggressive. If you're really thinking stock will go up, this is a very good way to go. Otherwise, if you're conservative, you could do 175 and 190. This $15 spread here, it's a better bet, I would think. So with that, that's one. And let's go back here to our PowerPoint here. Let's look at one more here. For that, let's go to, let's see here, Clean Spark. I think this is let's look at this one, Clean Spark CLSK. With that, let's go back here, CLSK. So Clean Spark, going to the chart here quickly. Chart is kind of indicating it's kind of trading sideways, and now it's showing some strength. RSI is showing some improvement here, going up. That's a good sign. On the balance volume is pretty steady. I think people are buying the stock here. Check-in money flow is showing a higher. It's smart money is flowing into the stock. Those are all good indications. Now if I go to TTM trade here, we got a let's see here. I think we don't have a dot here. I think let's go back here very quickly. On a spark, I think in a 1 week chart we got a dot. Go back here. On a weekly chart, yeah, we got a dot here, and stock A wave, C wave is above 0 at this point. I see some bearishness here. It's not a clean setup because C wave is trying to go below. It's not a good setup. We would ignore this one. If the C wave is steadily above 0 with the light blue, then it's a good setup. But in this case, Clean Spark is not a good setup. And if you want to be a contrarian because stock has fallen down, you could do it, but it's not a great setup. So with that, let's go back here. Let's look at one more. Let's look at 8x8 EGHT is it's a collaboration type software, working from home type software. All right, so EGHT in this case, I think here it's a bullish from a check-in money flow perspective. The blue line is above red line. That's a bullish from a DMI perspective. RSI is going up. That's bullish, and on the balance volume is also going up. That's bullish. So with that, let's go back to TTM trade chart here. I see a dot, some lines here. I think there's a squeeze. There is one more squeeze forming here. There's a squeeze over here in the weekly chart also, and A wave is kind of above 0 here in the weekly chart. It's clearly above 0. That's the bullish sign. I think this is a better setup than the previous one. So with that, let's go into trade option chain here. 8x8. We could probably go 117 days out. Stock is at 33. You could probably do say 30-40 spread here. If you do 30-40 spread, there you go. So you're paying 420, and remaining $5.80 is your profit. So with that, if you confirm and send, you're paying 480, you're making 580. You're more than doubling your money. You don't need to keep this till the 20th of August. If you make a good profit, you can sell it off. So this is one way to pay. This is a little bit aggressive. If you want to be a little less aggressive, you could also do 25-35. If you do 25-35, So now you're paying a little more money. So you're paying, I think, $6.45. Let's confirm and send here. It didn't change. Let's actually cancel this and do it again. 25.35. There you go. You're paying $6.45. You're making a little bit less money, so it's not a good setup. I would go with the previous setup. You could do 30-40 spread, or if you don't want to spend so much money, you could also do 30-35 spread. That's a little bit different way to play. 30-35 spread. So if you do a 30-35 spread, it's a $5 spread. You're paying 270. You're going to make little less than doubling your money. You're making $230 and you're spending 270. This is a little bit more conservative play. You're not spending too much money, but you're also not making too much money either. So with that, let's go back here. Let's look at a different strategy. I have one more here for Ttm squeeze. Let's look at a monthly squeeze as an example. For that, let's go to let's go to Collagium, because in here we got Collagium. I think that's also good. And even here, let's go to ALNY. I think that's a good one too. ALNY, go back here. It's a pharmaceutical company. And let's go to the chart here. So as you look at the chart here, stock is kind of trading sideways. On the balance volume is racing pretty steadily, which is good sign. RSI is kind of trading sideways at this point. And right now stock is bearish. Smart money is trying to go into the stock at this point, which is a good sign. And with that, let's go into TTM trade indicator. So here there is a squeeze trying to form in the 1-day chart. Short-term wave is above 0. Long-term wave is below 0. It's not a clean setup. Here also there is a squeeze formed in the 2-day chart. Short-term wave is trying to get above 0. Long-term wave is above 0. That's a good sign. And as you go into 1 week, I think long-term wave is above 0. And on a monthly basis, long-term wave is above 0. And monthly there is a dot. There's a squeeze being formed. So this is a cleaner setup. There's a dot in a monthly. A wave is above 0. C wave is above 0. That's a good sign. Let's go back to the option chain here. ALNY $136. I would go maybe 145 days out because we are buying the options. We want time to be on our side. So I would go in here. I would go 130, 140. It's it's a good conservative play here. 130, 140. So you're paying $460 and remaining portion of this is a $10 wide spread. You're paying $460. Your remaining amount, which is $540, is your profit potential. So with that, you're paying $460, making $540. You're more than doubling your money. Your max loss is $460. That's what you're paying. So I think it's a good play here if the stock stays above 134, which is really below the current price. You'll break even. I think this is a good setup. We could take this. If you want to play a little more bullish, stock all-time high is 178. You could also do 145 if you want. It's a $15 wide spread. That will give you a little more room to run from a profit perspective. You're paying 720 and you can make 780. It's again more than doubling your money, which is a good play. So with that, now let's go back to our PowerPoint slide here. And we looked at TTM squeeze. You can look at other ideas also. Just do similar thing like I was doing. Look at this at leisure. I will go into one more idea. This idea is around low IV percentile and low RSI. The moment IV percentile is low, that means you're not paying too much when you buy a call option or a call spread. And when when the RSI is low, that means stock has more room to run. So with that, let's look at a couple of examples here. First one is Arcadia Pharmaceuticals ACAD. So Arcadia, as you can see here, stock has stalled out, and now I think it's trying to. I don't know. There is not good sign here. Arcadia, I think the check-in money flow is indicating it's stable at this point, and RSI is kind of below. It's 29. What I would do in this scenario, check in, in the Arcadia scenario, I would not buy a call option here or a call, mainly because we don't know too much when the stock will come up. So good idea for stocks like this is to buy stock itself versus call option. If you want to buy call option, you would buy a little bit longer term. For example, if I have to buy this call option, I would even go a little further away. Maybe I think 145 should be okay. I would buy you know 70 delta as an example somewhere here. I'm paying $5 here, and for $5 I'm buying one call option here. My profit potential in infinite. If somebody is buying Arcadia Pharmaceuticals because it's so cheap, I will end up making money. Every dollar move will make me 70 cents. That's a good way to play versus buying stock. Other good idea is to buy the stock outright. It's really cheap. You could buy the stock and keep it for a long time. You don't need to worry about time decay in this scenario. Or if you want to buy a spread, I would buy maybe 15-25 spread. You could go here 15-25. There you go. You're paying $4.65, and you're making 535. This is a different play here because you're buying a spread. You're not too much worried about you're losing only 465. So in this scenario, from a risk reward perspective, I would not buy this spread. Instead, I would buy call option outright at 70 delta, because you're paying just $5, which is a better play. So with that, let's go back here. I would probably look at one or two more. For that, let's look at see here, Exelixis. That's also a good one. To make it, we can also look at some stock with a high short ratio, so that way we can see if we can take advantage of that. I would not go with CarGurus, Campbell Soup. That's again a stock doesn't move that often. iRhythm is a good one. Let's look at iRhythm, IRTC. iRhythm stock has fallen off drastically. I think last 2 weeks ago or so. As you can see, your chart looks ugly at this point. So let's let's look at the option chain here for iRhythm. I would probably go 117 days out. That's a good time frame. I would do maybe 75, 85 here, right here. There you go. So you're paying $4 for a $10 wide spread. Remaining $6 is your profit potential. You could go ahead and send this. I think it's a good play. Only caveat I have, by looking at the chart here, it's not showing the sign of improvement yet. So that's why we bought a spread for longer term. It might show sign a little bit later, but right now it's not showing the sign. That's why spread is a good idea, because that way the theta decay is a little bit low with the spread versus buying the call option outright. So with that, let's go back here. We'll probably look at one more here. For that, let's look at Checkpoint Software, CHKP. IV percentile is low again here, 24%. So Checkpoint Software, I think here it's at least trying to make some move higher. It's a good sign. And RSI is showing some sign of improvement. On the balance volume is trying to raise. The blue line is above red line in DMI. That's a positive indication. And the ADX is also trying to go up. That's a bullish sign. And check-in money flow is showing some signs of improvement. This is a good one for call buying or even call spread. So with that, let's go to option chain. We could even do either 82 days out or 173 days out. Probably 173 is better off here. You could do right now 119. I would do maybe say 115, 125. There you go. So you're paying $4.55 for a $10 wide spread. Remaining amount, which is 545 is your profit potential. Oops, sorry. 115, 125. So 545 is your profit potential. You're more than doubling your money. It's a good risk reward. And if you want to buy put option, if you want to buy call option outright, you could do something like this: 70 delta call option. You're paying $16, but your profit potential is infinite. You will only lose $16.50. That's pretty much. So let's look at next strategy. Next strategy is really either buying a stock itself or selling put or selling put spread. So with that, these are the stocks for this strategy. The way we come up with this strategy is really we want to make sure the IV percentile is high. So that way when you sell put option, you're bringing in more premium. At the same time, you want RSI to be low a little bit because you want the room for stock to grow higher. So that's why these are good ones. If you look at stock like a Activision Blizzard example, let's go back here, ATVI, and if I go to chart here, nice IV percentile 78.3, that's good. RSI is low, that's what we want. On the balance volume is kind of steady. People are buying the stock. And if you see DMI, at this point it is a bearish sign. That's why premium is high, but nothing to worry about. And if you look at check-in money flow, money is flowing into the stock, which is a good sign. So with that, I feel good about the setup. So when you're selling a put option or a put, premium put spread, you would want to go 45 days or before. You could, in this case, you could go 40 days here. Stock price is 93. So if you want to sell put option, so if you see here delta 30, it's $88. You could sell this, but it's a little risky. If you think it's a little risky, you could even go delta 20 somewhere here. You are bringing in $1.18. You could just sell the put outright. If the stock comes down to 85, you will end up buying the stock because you're collecting the premium. That's what you're obligated to. But you can always roll this and roll it to next month. That's okay too. So this is a good strategy. If you confirm and send here, you're bringing in $115, and every day as stock goes up, you will that there is a theta decay. You'll make some amount of money every day. So this is a good strategy. But if you want to buy a spread, you don't want to take too much risk. For example, if I sell this, so So there is a risk here. Your buying power effect is 1072. So because you'll end up buying the stock at $85 here. Ultimately, you have to have money to buy the stock. If the stock comes down, you'll be put, this stock position, it will be assigned to you. So that's why it's a little bit risky strategy for some folks. But if you want to buy the stock itself, it's a good strategy. But you could always roll. That's another another way to play this. One more way to do it is really you can do a put spread. For example, you could do say here we got 20 delta right here. You're paying $1.18. When you're selling the put spread, you can be a little more aggressive. You could do something like 30 delta if you want to go that much. I think it's a little more risky. You could do maybe right here 26 154. You could do 8780 spread. So if you do that, you're selling 8780 spread. There you go. So if you sell this spread, it's you're bringing in $108, and your buying power effect is 592. So this is your buying power effect, and your max loss is 592. So this is a little bit better proposition. If the stock falls down drastically, also you're going to lose only so much money. So typically, this type of limited risk strategy or defined risk strategy is a little better at times, because you don't need to lose sleep, because you're only obligated to this small spread here. So this is a better way to play put option. So let's look at one more put here. For example, we could look at probably charge point here. Charge point is a very high risk, high reward type stock. As you can see here, IV percentile is 56. So, let's go to charge point, and let's go to chart here. So as you can see here, RSI is around 48. IV percentile is right here 56. And stock, I think check-in money flow is showing some strength, which is good. So with that, let's go to option chain here. 40 days out is good, so $24. You could sell a delta 20 or so, but there is not too much money here, as you can see here. You could do maybe right here 28 cents, 18. Yeah, there is not too much money in this. You're not making money at all. Let's ignore this and go to the next one. So here, if you look at right here, GSX is a battleground stock. The stock has fallen down so drastically. That's why premium is so high with GSX, and so is Luminar. You could do, let's try with GSX here. So GSX, as you can see here, stock is trying to go up a little bit. There is some sign of improvement here. RSI is also kind of trying to go above the 50% mark, or a 30 mark here. Check-in money flow is showing some steadiness here. And on the balance, volume is trying to go up slowly, as you can see here. So at this point, it's really showing some sideways pattern or a trading range at this point, but it might recover as we go forward. So it's a little bit risky bet. Let's see what we can do here. $27 stock, up 17 cents on Friday. You could here there is very nice, very nice premium here. People are really, say if you could even sell a $15 $15 put option here. You're bringing $1.46. And delta, as you can see, a 13 delta. I think this may be a good bet here. If the stock comes down to $15, you'll end up buying the stock at this time, or you could even roll it up later. So you're bringing in good amount of money because there is risk involved in this. This is a battleground stock. So that's one way to play. But if you don't want to take so much risk, you could even do a spread here. You could do 20-15 spread. So if you do that, you are selling 20, buying 15, you're bringing in 19 cents. I think this could be a little bit better play because you can sleep well at night. So there you go, you're making a $90 profit, and your max risk itself is max loss is 410. So this is one way to play, and so this is the entire list. You can just look at some of these ideas and see if it makes sense to you. So with that, happy trading. Thank you.